Stocks are indeed trending higher today. The S&P 500 looking to snap a three-day losing streak. Bonds moving in the opposite direction. The 5-year showing the biggest drop going into the close. And joining us now, RiverFront Global Fixed Income CIO, Kevin Nicholson. Kevin, it's good to see you. We've had some volatility in the bond market today, driven in part by some commentary from the Bank of Japan. But of course, in general, recently, the trajectory has been yields lower, prices higher. What are we looking like into the Fed meeting next week?
Well, I think that the bond market has overreacted. I expected yields to come down as the economic data had slowed. But what we've seen is that we've seen roughly 85 basis points of yield come out of the bond market. And one of the things that the Fed had focused on was saying that financial conditions were sufficiently tight because of the rise that we had seen at the long end of the curve. But effectively, we've undone those rate hikes that the Fed was speaking of with this big move that we've had in the yield curve. So, right now, what the Fed funds futures are indicating is that they're for two cuts next year. And right now we are not in agreement with that. We're thinking that rates are going to just be held steady.
And Kevin, can I just ask you, when you think about what's driving this big rally in bonds, I mean, look at the yield on 10-year, 4.13 here. If you were to, listen, you could talk about cooling inflation and as you were mentioning, the market's expectations for the Fed. I'm just wondering, Kevin, do you think this is in part also is this investors covering shorts as well? I mean, when you see a rally like this, it certainly comes to mind.
Yes, I think that at this point there is some FOMO going on, especially going into the end of the year. Our investment thesis is that we're going to possibly, continue this rally through the end of the year, but we're going to see this flip at the beginning of next year as calmer heads prevail. Just because when you look at the data, we're not slowing to the pace of a recessionary pace, and that is basically what the bond market is pricing in is recession, given the fact that yields have moved so fast and come down so quickly.
It's interesting. I'm looking at your forecast for next year. You're looking at a 2024 10-year of 4.75%, obviously well above where we are right now. But 2024 is a long period of time. Like, what are you seeing that as the average for the year? Are you seeing that as year end? And what's going to drive those yields back up to that level?
I think it's more of the average for the year. Mm-hmm. As I think yields will get pushed back up to that level if we do not see the rate cuts. And right now, like I said, the market is forecasting 2 rate cuts in the first half of the year. If we don't see that happen, then you're going to all of a sudden see a lot of the momentum that has been in this market actually pushed out. And one of the things that I look at is where are we on inflation, specifically sticky inflation, so CPI. And sticky CPI is still at 4.95%. That's well above the 2% range that the Fed is looking at, or the target that they are looking at. And more importantly, sticky CPI encompasses the big expenditures such as shelter and medical expenses and education expenses. And, and that's where people are going to spend the bulk of their money. So I think that the market has just gotten ahead of itself. And also the market is also depending on spending to slow down. But when you look at, ADP's report yesterday, and you look at where the wages are for the folks that are, job changers, they're still getting pay increases of 8.3%. Those job stayers are getting wage increases of 5.6%. And you have headline CPI sitting at 3.2%. And even in the non-financial companies, they're getting wage increases of 4.5%. So the wage increases are still higher than inflation. So that's going to lead to more spending. And I think that that's going to cause the Fed to be higher for longer than the markets are anticipating right now.
And so, Kevin, kind of, let's just keep on that argument right there in terms of wages, I'm just interested tomorrow, another big data point, that big jobs number, Kevin. Let's say that comes in, hotter than expected, stronger than expected. What would you expect to see in response in the bond market?
If it comes in hotter than expected, I think that you're going to probably see the bond market go up by 10 to 15 basis points. I think that you're going to really see a sell-off abruptly, and not to the same degree as that the momentum that we got to the downside, but I think that you're going to cause a lot of investors to rethink their investment thesis that the Fed is actually going to cut rates instead of just leaving them higher for longer. Because right now, the market is fighting the Fed. And, that is our golden rule, is not to fight the Fed. And, all year long, the market has been fighting the Fed. And all year long, they have been incorrect. And so we'll see whether or not the Fed continues to have the advantage, or if the market has the advantage.
And Kevin, finally, I want to ask you also about a little bit of a technical support for treasuries that we've seen to some extent for years, and that's foreign demand for treasuries. Some of the more recent auctions, not just for foreign demand, but domestic demand as well, has been choppier. How are you seeing that factor going into 2024 as well at play in the treasury market?
Well, Julia, it's funny that you mentioned the auctions, because we have a 3-year auction and a 10-year auction next week, and 30-year. And it's going to be important to look at those auction results next week to kind of give us some insight of how it will how yields will react going forward, because now that we're down nearing 4% on the 10-year, it's going to be a very different atmosphere as it pertains to the number of buyers that comes in. Additionally, when you think about the fixed income markets, you think about Japan. Japan is the largest holder outside of the U.S. of our treasuries. And if the BOJ actually decides to finally get rid of yield curve control, their yields are going to go up, and that's going to entice more of Japanese buyers to actually stay at home and not participate in our treasury market. So then that's going to take some demand out of the treasury market as well. So that's part of the reason why I have yields expecting yields to be a little higher in 2024, but I don't think that we're going to reach the highs that we saw this year.
Kevin, thank you so much for joining us today. We appreciate it.
Thanks, Josh.